You look at the postcard, turquoise water, an endless parade of perfect sunshine, and a skyline that glitters like a handful of spilled diamonds. This is Miami, the so-called magic city, a place where reality often takes a permanent vacation. For years, the narrative has been one of explosive, unstoppable growth. A coastal fever dream attracting global wealth, a tax-friendly paradise where billionaires land their private jets and the champagne never stops flowing. But what if the glitter is just a thin, fragile layer over a deep, dark abyss? What if the most sought-after real estate on the planet is, in reality, the world's #1 most volatile, most dangerously inflated financial bubble? Hold on tight, because we're diving headfirst into the storm surge of Miami's impossible market, a financial landscape so detached from logic it makes the 2008 crash look like a minor tremor. The evidence is screaming, but nobody wants to hear it. According to a leading international investment bank's Global Real Estate Bubble Index, Miami is the city most at risk of a spectacular, catastrophic crash, topping a list that includes cities like Tokyo, Zurich, and Los Angeles. We're not talking about a slight market correction. We're talking about a phenomenon so extreme that its key indicators have blown past the highest peaks of the last major bust, the one that nearly cratered the global economy. Let's start with the impossible numbers. Over the last 15 years, Miami has experienced the strongest inflation-adjusted home price appreciation of any major global city studied. Think about that for a second. Not New York, not London, not even San Francisco's tech-inflated insanity, Miami. The price-to-rent ratio, a foundational metric for determining a bubble, is currently higher in the Magic City than it was at the absolute peak of the 2006 frenzy. You heard that right. The gap between what it costs to buy a home and what it costs to rent one, the profit margin built on pure, speculative air, is wider than ever before. This is a telltale sign of a bubble, where prices are no longer driven by the sensible, local fundamentals like wages and rental income, but by something far more intoxicating, pure, unbridled speculation and a flood of external, liquid capital. During the pandemic-era boom, which supercharged Miami's status as a Wall Street South, the market became a runaway train. Remote work became the golden ticket, a mass exodus of high-net-worth individuals and major finance firms fleeing high-tax states like New York and California, drawn by Florida's zero-state income tax and business-friendly environment. They arrived with unprecedented buying power, looking for lifestyle and financial refuge. The result? A market frenzy where properties were snapped up sight unseen, often in all-cash transactions that bypassed the standard financing scrutiny that might have applied the brakes. Cash, in Miami, is still king, with cash transactions representing well over 40% of sales, nearly double the national average. This international and domestic capital acts as an insulator, protecting the market, in the short term, from the interest rate hikes that have devastated affordability in other cities. But this cash-fueled resilience is a double-edged sword. It drives prices into the stratosphere, creating a terrifying schism, an ultra-luxury market of gleaming new condo towers and waterfront mansions, and a local market where the average resident's income can't buy even a sliver of the dream. The disparity is stark and growing. While the median home sale price has soared, local incomes have crawled behind, creating a grotesque distortion in the price-to-income ratio. For most people working and living in Miami, true homeownership is no longer a goal, it's a financial fantasy. This isn't just an economic story, it's a story of a city fundamentally changing, where its vibrancy and culture are being priced out by an invisible hand of global finance. And yet, many local real estate experts, the people who profit most from the boom, insist the bubble talk is wrong, arguing that Miami is a unique, misunderstood market supported by real capital, international appeal, and a limited supply of land. They claim the high percentage of cash buyers means the risk of a mass foreclosure wave is low. But even as they dismiss the warnings, the market is beginning to feel the strain. Sales volumes are down, inventory is rising, and homes are starting to linger on the market for weeks longer than in the past, a clear sign that the buyer enthusiasm is waning and the frenzy is cooling. The most alarming factor isn't just the sticker price, it's the hidden, systemic costs that are ballooning beyond control. We're talking about skyrocketing property insurance rates in a city directly exposed to the increasing threat of climate change and hurricane damage. We're talking about massive, multi-million-dollar condo associations' special assessments for building maintenance and mandatory structural repairs, a tragic consequence of deferred upkeep and aging infrastructure made terrifyingly real by the Champlain Tower's collapse in Surfside. These ballooning costs are hitting existing homeowners and condo owners like a financial tidal wave, turning a seemingly solid investment into a crushing, ongoing liability. This is the ticking clock beneath the pristine beaches. The question is no longer if the pressure will become too much, but when and how spectacularly the Magic City's real estate mirage will shatter. The stage is set for a dramatic reversal, and in the next part, we'll peel back the layers of this unique market, examining the historical forces that have made Miami a boom-and-bust capital since the 1920s and why this time, the collapse could be deeper and more devastating than anything the city has ever endured, a financial perfect storm brewing on the horizon. The first warning siren blared, but the partygoers in the present-day penthouses barely flinched. Why would they? They're too busy celebrating the eternal summer, basking in the glow of their paper gains. But for anyone who understands the rhythm of this peninsula, the name Miami rings with a unique, almost supernatural association with financial collapse. We must rewind, not just a few years to 2008, but back to the genesis of the madness, the legendary Florida land boom of the 1920s. Imagine the scene a century ago, an almost biblical frenzy fueled by national prosperity, easy credit, and the irresistible, almost mythological promise of paradise. A tropical escape from the industrial north. Land was bought and sold 10 times in a single day. Speculators, the ancestors of today's global investors, were trading deeds on paper for swampy lots that barely existed, promised future development, future mansions, future golf courses. They built grandly, sold on hype, and believed the sunshine would last forever. Then, in 1926, the bubble burst, pricked not just by a hurricane, but by the simple, brutal weight of overvaluation and leverage. The fallout was devastating, leaving unfinished developments and financial ruin across the state for years. Fast forward 100 years to the 2000s condo boom, and the script was eerily similar. Easy financing, rampant development, and an assumption that prices only moved one way, up. When that bubble popped, Miami, once again, found itself ground zero for financial devastation. Now, we are here, in the supposed smarter era, yet the fundamental disease remains identical, perhaps even mutated into a more resistant strain. The old boom was fueled by land speculation and local credit. The new boom is powered by global capital flight and the perception of Miami as an unassailable offshore vault. The core mechanism, buying based on the expectation of what the next person will pay, rather than the asset's intrinsic value, is the same magnetic force pulling both eras toward the inevitable singularity. The narrative today is that this time is different. The common refrain is, the buyers are wealthier, or, the cash buyers shield us. But let's dissect that defense. The sheer volume of cash transactions, 42% plus, certainly changes the mechanism of the crash. It might mean fewer immediate foreclosures from banks, but it doesn't change the valuation problem. When a significant portion of buyers are international investors seeking a safe harbor, their primary concern is capital preservation against political or economic instability elsewhere, not whether a local school teacher can afford the monthly payment. This creates an insulated, high-altitude market where assets are priced for the stability of a Swiss bank, not the underlying economic reality of a South Florida metropolis. When that global confidence wavers, or when the perceived risk of holding physical assets in a coastal zone rises too high, hello, insurance crisis, that protective layer of cash can dissipate rapidly, leading to sudden, sharp price drops as deep-pocketed sellers flood the market simultaneously to relocate their capital. And let's talk about those local fundamentals, the ones the global cash buyers ignore, but which are vital for long-term stability. While the UBS report rightly highlights the insane price-to-rent ratio, it's crucial to understand the hidden components that are actively eroding the net worth of existing homeowners. We are talking about insurance. Forget the list price for a moment. Look at the carrying cost. Homeowners' insurance premiums in South Florida have become utterly astronomical, in some cases doubling or tripling in just a few years due to increased hurricane risk modeling and reinsurance costs. This isn't an optional expense, it's a mandatory fee for the privilege of living here. Furthermore, the specialized, aging condominium stock, the towers that define the Miami Beach and Brickell skylines, are facing a reckoning. The Surfside tragedy wasn't an isolated incident. It was a flashing red warning about the catastrophic financial liability embedded in these concrete giants. Suddenly, buyers aren't just looking at the $1 million condo price tag. They are facing a potential, mandatory $100,000 to $300,000 special assessment to fix structural deficiencies across the entire building. These assessments, often payable in a lump sum or over a tight time frame, can instantly wipe out a homeowner's equity or force a distressed sale, regardless of how much cash they used to buy in the first place. This is the system's self-correction mechanism beginning to kick in, not necessarily through falling list prices, but through a massive, unavoidable increase in the actual cost of ownership. The price correction isn't just happening on Zillow, it's happening in the monthly budget, the annual premium notice, and the terrifying email from the HOA board. The allure of the city, the lifestyle, the nightlife, the 365 days of sun, is the drug that keeps the speculative volume high. But what happens when the cost of the medicine becomes more expensive than the cure it was meant to be? The market shifts from buying a home to buying into an escalating liability. This transition is often the quiet, unseen catalyst that turns a high-risk market into a genuinely distressed one, a subtle but powerful undercurrent that the headline numbers often miss, setting the stage for the next, perhaps final, act of Miami's cyclical financial drama. The air is getting thick with caution, the once unwavering optimism is developing hairline fractures, and the historical ghosts are starting to whisper louder. What will break first? The global confidence holding the cash reserves, or the local infrastructure buckling under the weight of its own inflated value and rising operational costs? This tension is what makes Miami's current position so perilous. So, if the traditional metrics, local income, sensible rental yields, are screaming danger, what precisely is sustaining this gravity-defying elevation? The answer, much like the city itself, is a complex, glittering mosaic of international desires and new-age financial speculation that masks the fragility underneath. We have established the historical precedent and the imminent operational costs, but the engine of this perpetual boom is fueled by two primary, powerful, and ultimately transient forces: the expat migration and the crypto/digital wealth flood. Let's pull apart the expat effect. Miami has successfully branded itself as the ultimate safe harbor for the globally mobile rich, particularly those fleeing the high regulatory burdens and direct income taxes of the Northeast Corridor and parts of Europe. This influx of domestic high-net-worth individuals, HNWIs, brings significant capital, but their purchasing behavior is fundamentally different from that of a traditional local buyer. They are not buying a home based on a 30-year mortgage anchored to a local salary. They are buying an asset diversification vehicle and a lifestyle package. This drives demand intensely at the very top end, the 5 million, 10 million, and ultra-luxury 100 million tiers. These properties are scarce, and their transactions are less sensitive to minor interest rate fluctuations, reinforcing the perception of invincibility at the apex of the market. However, this creates a significant market segmentation problem. While the luxury segment remains fiercely competitive, the demand at the median price point, the properties that most local service workers, teachers, and firefighters actually need, is increasingly reliant on the middle class's capacity to afford those high carrying costs we discussed earlier. When those carrying costs, insurance, assessments, become unbearable for the domestic buyer, the local demand evaporates, leaving a market dependent on the next wave of expatriate capital, which can dry up overnight with a simple shift in federal tax policy or global politics. It's a house of cards built on legislative goodwill and offshore bank accounts, not community stability. Now, let's address the most modern, perhaps most ephemeral fuel for the fire: the integration of digital wealth. Miami has aggressively courted the cryptocurrency industry, positioning itself as the crypto capital of the Americas. This was a calculated move to attract entrepreneurs and investors whose net worth is often volatile, denominated in assets like Bitcoin or various altcoins. When crypto markets are roaring, these individuals have significant, highly liquid capital they need to rapidly deploy into hard assets, often viewing real estate as a quick off-ramp from digital volatility. This creates sudden, intense bursts of demand at high price points, frequently executed in all-cash deals. But this is where the term bubble becomes most acutely relevant. Bubbles driven by tangible fundamentals, like steady job growth or organic population increase, tend to deflate slowly. Bubbles driven by speculative, highly correlated non-fiat assets, like meme stocks or cryptocurrencies, can deflate with terrifying speed. Imagine a sudden, severe bear market in major digital assets. The capital that rushed into Miami condos seeking stability suddenly needs to liquidate assets elsewhere or faces margin calls. Their incentive to hold a highly leveraged, high-cost physical asset in South Florida vanishes. The digital gold rush created artificial bidding wars. The digital winter could create artificial fire sales. The sheer speed of liquidation in the digital world contrasts sharply with the slow, agonizing sales process in physical real estate, meaning the downswing could be instant and brutal. Furthermore, this entire ecosystem, the glamorous conferences, the new tech headquarters, the endless stream of digital millionaires, creates a potent media feedback loop. The constant promotion of Miami as the place to be generates FOMO, fear of missing out, which attracts more speculators who drive up the prices, which generates more glowing media coverage, confirming the initial delusion. It is a self-fulfilling prophecy on a loop, but a loop requires constant energy input. If the energy, the influx of new money, stalls, the momentum collapses. We see hints of this stall already. Inventory is creeping up, days on market are stretching. The market is slowing its sprint, but the narrative insists it's still flying. The critical question remains, are the true, sustainable local job sectors, the fintech hubs, the established finance firms, growing fast enough and paying wages high enough to absorb the inventory and support those soaring prices if the international and crypto wealth decides to pivot? The historical precedent suggests a resounding no. We are building the most luxurious castles on the sands of speculative hope, and the tide, as it always does in Florida, is beginning to turn. If the financial metrics of speculative value are the dizzying heights of this potential bubble, then the very physical foundation of Miami real estate is the ticking time bomb beneath it. We've touched upon it, the insurance crisis and the looming special assessments, but we need to drill down into the terrifying reality of owning property here, especially in the thousands of high-rise condominium towers that dominate the skyline. This is where the global investor meets the harsh, localized, unavoidable cost of a changing climate and decades of regulatory oversight failures. For anyone purchasing property in Miami today, the dream ends the moment the annual insurance renewal notice arrives. We are no longer talking about incremental increases, we are talking about existential cost inflation. As major insurers pull out of Florida entirely, citing unsustainable risk exposure from hurricanes and rising sea levels, the remaining carriers, often smaller, state-backed options, are forced to price the risk to reflect a near certainty of catastrophe. Premiums are not just rising by 10% or 20%, they are doubling, tripling, sometimes quadrupling the annual outlay for a single unit. For the cash buyer, this is an expense. For the financed buyer, it can be the difference between an affordable monthly payment and complete financial disqualification. This singular factor has already choked off the affordable segment of the market, acting as an organic brake on price growth for anyone needing a mortgage. But the financial trauma doesn't end there. It converges with the second, perhaps more insidious threat, the Condominium Association's special assessment. The devastating collapse of the Champlain Towers South in Surfside was not a freak accident of nature. It was the spectacular failure of governance, maintenance oversight, and financial planning over decades. It revealed that many buildings in the region, constructed during previous boom cycles, have significant, unaddressed structural deficiencies, concrete spalling, rebar corrosion, facade decay. The state of Florida mandates structural milestone inspections, but the necessary repairs are often staggeringly expensive, costing millions for a single building. The owners. If the reserve funds are inadequate, and in many boom era buildings, they were intentionally kept low to keep HOA fees attractive during sales cycles, the cost is levied directly onto unit owners through massive, non-negotiable special assessments. Imagine buying a $1.5 million condo, only to be hit 3 months later with the required $150,000 lump sum payment, or facing foreclosure if you cannot produce the cash. This single assessment can instantly vaporize the equity gained from years of supposed appreciation. The risk is no longer just about the market value going down. It's about the cost of staying afloat going up exponentially. This is fundamentally different from the 2006 bubble, which was primarily a mortgage and securitization problem. This is a physical asset liability crisis intersecting with a climate risk crisis. The speculative money that poured in for tax advantages or as a hedge against foreign instability cares little for corroded concrete or soaring insurance ledgers, until the cost exceeds the asset's perceived worth. When those assessments become frequent or when the insurance premiums become so high that the total monthly outlay, mortgage/HOA/insurance, exceeds what a local salary can bear, the market hits a hard, non-speculative ceiling. This is the reality that many new owners, seduced by the luxury view and the promise of Wall Street South, failed to properly underwrite. They bought the dream, but they failed to account for the inevitable, expensive reality of owning property on the edge of a rapidly changing coast. The infrastructure itself is presenting the bill for the entire cycle of speculative excess. And this looming financial reckoning is about to collide violently with the next wave of economic uncertainty. We've established the forces pulling demand to unsustainable heights: global cash, crypto liquidity, and the relocation of the wealthy. We've detailed the hidden dangers waiting in the very concrete of the buildings, the insurance and assessment time bombs. But the narrative of the bubble is incomplete without analyzing the other side of the ledger: supply. In any market facing overheating, the logical safety valve is increased supply, more construction, more inventory that meets the actual, sustainable demand. In Miami, this safety valve is almost entirely broken, or at the very least, severely clogged, leading to an artificial scarcity that props up prices across the board. First, the geographical constraint is absolute. Miami-Dade is a coastal county squeezed between the Atlantic Ocean and the Everglades. Buildable land is finite. This scarcity, which under normal circumstances is a sound investment principle, becomes a dangerous accelerant in a speculative boom. Developers know they can build something and it will likely sell, which keeps land acquisition costs perpetually sky-high and pushes new construction further and further inland, often into areas with increased flood risk that haven't yet been fully priced into the insurance models. Second, and far more critically, is the inventory skew. The overwhelming majority of new construction being delivered today is not aimed at the median income earner: the nurse, the teacher, the police officer, the service professional who keeps the restaurants, hotels, and banks actually running. Instead, the cranes are almost exclusively dedicated to the luxury and ultra-luxury condominium segment. These towers are being financed and sold based on the demand profile of the global HNWIs we discussed previously, not the local workforce. This leaves a massive, cavernous hole in the housing stock for those residents whose salaries have not magically grown 180% in a decade. They are forced into the existing older housing stock or into the rental market, putting intense upward pressure on those rents, which, ironically, is what makes the price-to-rent ratio look so dangerous for the long-term stability of the entire ecosystem. The market is building trophy assets for the world's elite while simultaneously starving the community that forms the city's operational backbone. This means that even if the speculative tower market experiences a correction, the baseline cost of living for the majority of Miamians remains cripplingly high because the actual supply meeting local demand is shrinking due to attrition, age, and soaring maintenance costs. Furthermore, the regulatory environment, while attempting to mitigate risk by imposing stricter building codes post-Surfside, inadvertently slows down the production pipeline. New construction means navigating complex permitting, new, more expensive materials mandated by the updated codes, and longer build times. While necessary for safety, this friction further constricts the pipeline, adding to the cost base before the key is even turned. This supply bottleneck creates a perverse incentive. If you are a developer, why waste time on building smaller, moderately priced homes that will face intense regulatory scrutiny and lower profit margins, when you can build a 70-story luxury tower where early buyers are already depositing millions in non-refundable contracts? The market is optimizing for the speculative buyer, not the resident. This structural imbalance means that even if the bubble concerning the overvalued luxury condos deflates, the cost of living for everyone else will remain acutely high due to constrained supply meeting steady, albeit squeezed, local demand. The supply side isn't offering relief, it's reinforcing the price floor for the affluent while ensuring housing remains unattainable for the service class. This is the ultimate paradox. A city attracting millions for its lifestyle, yet systematically pricing out the very people required to sustain that lifestyle. The city risks becoming a magnificent, sun-drenched resort, impeccably maintained by an invisible, commuting workforce who can no longer afford to live within its dazzling borders. We have navigated the historical ghosts, the overwhelming capital flows, the crushing costs, and the disastrous supply imbalance. Now, we must turn our attention to the entities meant to guard the system, the regulators and the politicians. In any healthy market, when prices decouple violently from wages and risk escalates, government bodies step in to cool demand, increase supply of affordable units, and enforce stability. In Miami's case, the political environment and the regulatory response have not only failed to apply the brakes, but have often acted as an unwitting supercharger for the speculative market. The core issue lies in the pervasive ideology of pro-growth at all costs that defines Florida politics. The Wall Street South initiative, while successful in attracting major financial firms and high-net-worth individuals, effectively prioritized the interests of global capital over the stability and affordability needs of the local residents. Tax incentives, streamlined regulations for high-rise development, and a general hands-off approach to the ultra-luxury sector sent an unmistakable signal to global investors. Miami is open for unrestricted business. This governmental embrace of the luxury exodus created a profound conflict of interest. The massive tax revenue generated by soaring property values, often paid by non-resident investors, created a temporary boon for city coffers, making local politicians incentivized to keep the bubble inflating regardless of the societal cost. Who wants to be the politician that announces policies to intentionally cool the market? It's a political non-starter in a state that prides itself on perpetual growth. Meanwhile, the crucial, common-sense regulatory measures that should have been implemented to protect the general populace were either ignored or aggressively resisted. For years, measures to properly fund condominium reserve accounts, the very funds meant to pay for those massive special assessments, were fought tooth and nail by lobbyists who argued they would unnecessarily burden property owners and slow sales. It took a tragedy like Surfside for mandatory reserve funding and structural inspection laws to finally be passed, but the damage had already been done, leaving thousands of existing buildings with massive, unfunded liabilities. These new laws, while necessary, now act as a sudden, massive financial burden on existing owners, forcing distressed sales, rather than a preventative measure. This is a classic case of too little, too late. Furthermore, the city's approach to the affordability crisis is a perfect illustration of regulatory failure. Despite acknowledging the crisis, most solutions are token gestures, limited affordable housing projects that barely scratch the surface of the demand, or incentives that are often circumvented or absorbed by large corporate landlords. The political willingness to impose real limitations on rent increases or to create robust inclusionary zoning mandates, policies that would genuinely inject affordable supply into the market, is virtually non-existent, leaving the median earner completely exposed to the whims of the speculative cycle. Another alarming component is the minimal regulatory scrutiny applied to the high volume of international cash transactions. While U.S. banking laws require certain disclosures, The sheer speed and volume of foreign capital flowing into Miami real estate often bypasses the deep dive scrutiny necessary to ensure all capital is legitimately sourced. This opacity allows real estate to function not just as an asset but as a vehicle for capital flight and wealth sheltering, further detaching prices from any local economic anchor. When regulators look the other way, real estate becomes a store of value first and a home second, creating an environment ripe for overvaluation. The consequence of this regulatory vacuum is that the market now stands incredibly exposed. The two key defenses that could have provided a cushion, stable, income-based housing and properly maintained building infrastructure, were dismantled or neglected in the pursuit of exponential growth. When the market finally shifts, there will be no soft landing. The politicians may blame external forces, global economics, high interest rates, or even the weather, but the truth is, the most critical failures were internal, a deliberate turning of the blind eye in exchange for a few more years of glittering revenue. This entire phase of the boom was underwritten by the illusion of eternal prosperity, an illusion carefully maintained by those in power. And that illusion is about to face its harshest test yet, the reality of a global financial environment that no longer rewards reckless speculation. We have traced the journey of Miami's real estate from a gilded dream to the world's #1 bubble risk. We've unmasked the historical cycle, analyzed the unstable foreign and digital capital, quantified the terrifying cost of ownership hidden in insurance and assessments, and exposed the political system that failed to guard the gates. Now, we arrive at the final, unavoidable question. What does the popping of this specific bubble look like, and what are the final dominoes that must fall? Unlike 2008, where the crash was triggered by a systemic failure in subprime mortgage lending and bank solvency, this next reckoning will likely be triggered not by a single cataclysm, but by a chilling confluence of pressures, all converging on the same critical weakness: liquidity and confidence. The first domino is already teetering: the global confidence pivot. The wealthy expatriates and international investors who poured billions into Miami real estate did so seeking stability and tax relief. What happens when the perception of risk exceeds the reward? If global interest rates remain high, making debt more expensive worldwide, if other, newer tax-friendly havens emerge, or, most powerfully, if the physical reality of climate change and soaring insurance costs make South Florida assets a perpetual financial liability, that capital will simply shift. These H&Ws are not emotionally attached to Miami, they are attached to their balance sheets. When their assets become too costly to hold or too difficult to offload, the cash flood will reverse, leading to a sudden, dramatic drying up of buyers at the ultra-luxury segment. This is not a slow market correction, it's a sudden withdrawal of the primary source of market sustenance. The second domino is the service class exodus. As property prices and rents continue their relentless ascent, the core workforce, the nurses, the teachers, the restaurant staff, the maintenance crews, are forced to move further and further away, creating crippling commute times and reducing the quality of life. At a certain point, the city simply cannot function efficiently. Businesses struggle to hire, services degrade, and the very lifestyle that attracts the elite begins to deteriorate. This erosion of the city's operational efficiency devalues the entire asset base, creating a negative feedback loop where the reason for moving to Miami, the lifestyle, is destroyed by the cost of living that the move itself created. The third and perhaps final domino is the condo liquidity crisis. This is the one that directly connects the hidden physical risk to the financial market. Imagine a scenario where a dozen major condo towers across Miami-Dade simultaneously hit their mandatory structural inspection milestones and deliver special assessments of $150,000 to $250,000 per unit. Many existing owners, even wealthy ones, do not have this cash liquid, or they choose to balk at the demand. They are forced to sell their units before the assessment is due. This sudden influx of distressed inventory hits a market already slowing down due to lost global confidence. With fewer buyers and a desperate supply, prices plummet rapidly in the condo sector. Since the condo market forms the vast, dense core of Miami's inventory, this massive correction will cascade, dragging down the perceived value of the entire metropolitan area. The outcome: a unique collapse. This will not look exactly like 2008's wave of bank foreclosures. Instead, it will be a two-pronged collapse. The high-end market will crash due to a lack of buyers and sudden capital flight, and the median income market will crash due to unbearable carrying costs, insurance/assessments, forcing solvent owners into distressed sales. The resulting economic shock will be profound, impacting state tax revenues, construction jobs, and the finance industry itself, which will find its real estate collateral rapidly shrinking. The golden promise of the Magic City, built on the shifting sands of global speculation and unchecked ambition, will finally dissolve, leaving behind a stark and difficult truth. In Miami, the economic climate eventually succumbs to the dictates of the physical climate and the brutal, unforgiving logic of history.